G'day expats and welcome to another episode of Expat Chat, episode 104. Gosh, we're getting up there, aren't we, Brett? As always, joined with my co-host, friend, mentor, colleague, business partner, all the above, Brett Evans, who is the Managing Director and Founding Director of Atlas Wealth Group, and he is currently based over in the Middle East in the EMEA region. How is the sandpit treating you, Brett?
Mate, nice. It's very busy right now. Obviously, a lot of folks coming here. Dubai was actually voted as the most popular expat destination worldwide in an article earlier this week. So I can verify that the roads are packed, the hotels are full, everything's busy.
I,
So
and I tell you what, some of my clients in Singapore and Hong Kong, God, there's a lot of rumors moving around that everyone's heading over to Dubai. Everyone's heading to the Middle East. There's a
yeah,
few that are currently looking to make the move over there. I think, obviously, there's just a lot going on over in the UAE right now, especially even just the Middle East as a whole. You look at Saudi's push as well, but I am seeing seems to be just this shift happening towards more of the Middle East now rather than Southeast Asia.
yeah.
Maybe because there are a bit more lucrative opportunities, but I've definitely noticed a bit of a wind change in the conversations I'm having with a lot of my clients.
When you see Facebook group recommendations popping up, and one of them that keeps popping up on my feed is um, expats in Singapore moving to Dubai. There's actually a Facebook group
Mm.
for that. So
Yeah, it is. Yep.
and
Yep.
so yeah, it's definitely happening. And actually, I'm very rude. I've haven't introduced you, mate. So to the folks on the episode today, on my left, your right, whichever way you're looking at, is my colleague and mate and the absolute gun of the Gold Coast, Mr. James Ridley. James runs the Aussie team, a very quickly growing team actually.
Mm.
Every week we seem to be putting a new member on in the Australian office, and his speciality is managing the Asia and Americas region. G'day, mate.
G'day, and thank you for that intro. And today, Brett, good topic. Want to, I guess, bust a few myths, just because they keep coming up with a lot of Australians that I'm speaking to. Um, and I think it's also a case that these sort of things do the rounds in a lot of the Facebook groups and forums. And, yeah,
Urban
you can do
myths.
that, but don't do that because it'll,
Yeah,
it'll, cause you a lot of tax issues. But I want to just talk about managing foreign pensions for Aussie expats and best ways to manage them, dispel a bit of, or I guess a bit of myth busting around that and jump into it. But before we jump into it, Brett, I'll get you to do the little disclaimer.
all the information we're going to talk about today and share with you, good folk, should be treated as informational and educational purposes only. Do not treat this as personal advice. If you do need to get personal advice, reach out to Atlas.
Yep, absolutely, mate. And jumping into it, when we look at all the different types of foreign pensions that exist, the most common that I think a lot of people hear about it, you got your UK pension system, your SIPs over there. Obviously, really common ones are Provident funds, whether you're in Hong Kong or Singapore. In the US, there's quite a few different ones. You got your IRAs, which is broad stroke. You've got your 401ks, your 403bs, and you got your Roths. And then you jump on a plane and you head up to Canada, and then you got your RRSPs. And then if
Speeds,
you,
yeah.
yeah, that's it. You board over, then you can head on over to the Middle East, and I'll throw it over to you.
Then you got end of service benefits, or that's now changing, as we've discussed before, into the new
That's right.
employee workplace savings schemes.
That's right.
Obviously, with your airlines, you've got the Provident schemes. So then you go into
Yep.
Europe. I think last count, Switzerland's got 5 different tiers of foreign pensions that you can participate in, and then you got
Yep.
places like Denmark that have public pensions that you can't move.
Yep.
So anyway, I think
That's it.
the people get the point. There's lots of
Yep.
pensions out there. Most folks have access to one or many.
That's
So
right.
let's jump on this call and really just talk about can you, can't you, in
Yep.
terms of how you manage it. I think the most important one that I see a lot of friction with a lot of folks is people read the ATO website. Obviously, they suffer from insomnia, can't sleep at night, so that puts them to sleep. And in there, that talks about on the repatriation piece that you have 6 months to repatriate foreign pensions. Outside of that time frame, you'll be taxed. So people sort of get their knickers in a knot in terms of how do you transfer a UK pension back to Australia within 6 months. Well, the answer is you can't unless you're over the age of 55. But even then,
That's it.
HMRC is taking such a long time to register SMSFs on the RAPS list that you can't even get it done within 6 months anyway. We've got a couple of clients in the
Nope.
process going through that,
Yep.
and it's not happening. So, mate, I think, let's talk about can you move? Let's go at a high level. Can you move a foreign pension directly into super? Take it away.
No.
Yeah.
Plain and simple. There is no scheme or transfer method that you can just roll one straight into an Australian super fund, like a super fund on in Rest or CBUS or Australian Super, whatever you have it. That doesn't exist. And unfortunately, that is probably the biggest myth that runs around the different Facebook groups and online forums. Someone said it and then it snowballed, and often we're having conversations where they think they can roll, their RRSP, their Canadian RRSP straight into an Australian super fund, or same with a 401k in the US, or they can withdraw their Provident Fund and roll it straight into an Australian super fund. It doesn't exist. The scheme does not exist. The only one which doesn't really even come close is actually a UK pension. But as Brett just said, there is a really strict process you've got to follow to be able to do so. The minimum standard requirement or minimum criteria, age 55. So if you're in your 30s or your 40s and you're coming back to Australia and you want to bring your UK pension, well, you can't. It's still landlocked there until you look at transferring it via a SIP, or you leave it until you're 55, and then you obviously get hit with a bit of tax on both sides. And then even if you can transfer a pension, there's other criteria that you need to stay, I suppose, in between, which is the contribution caps. So back to the big question, no, there is no scheme where you can just transfer a foreign pension straight into an Australian super fund.
Just to explain to the folks out there too, I think it's important to understand the mechanics of how super rollovers work and stuff. So in Australia, we've got the super stream system. It's a domestic system. It doesn't connect internationally. There's no connectivity. It's not like the SWIFT payment gateways and stuff where all the banks are connected. This is just an Australian system that Australian super funds are connected in between with. When it comes to 401k providers or UK pension providers or RRSP providers or Provident Fund schemes, there is no connectivity. So when you do bring that money in, it is a metaphorical briefcase full of cash. And it's no different to you going to Melbourne Cup on Tuesday, backing your winner and getting cash and putting that in super fund. From a really simplistic point of view, it's the same treatment. The same rules apply, the same contribution limits apply in terms of a concessional versus a non-concessional. 27.5 for concessional pre-tax, 110 for non-concessional post-tax money. So that's the way you got to think about it. It's virtually, it's not part of the super or pension scheme anymore. Once you pull it out of that country, it is virtually your cash. You could put it in super, or you could go buy a boat. That's how granular it is.
Exactly right. And I mean, I think when you look at a lot of clients that come back for retirement, and they do have these lumpy foreign pensions, and they sort of have access to a couple 100,000 or even over $1 million, and then they can withdraw it all, and then they're left with the task of, oh well, how do I best get this squirreled back into my super? And then it's a case you can't just throw it all in. You've got to follow the right strategy. You've got to deal with the different types of contribution caps, which can always cause a few issues. So it's not an easy process. It's also a case where you've got an extra layer when, in the event you don't withdraw, you can't access your foreign pension when you come back to Australia or you move country because of your age. Maybe there's minimum age requirements with that certain jurisdiction. Then if you're back in Australia and then you start drawing an income stream from it, then you've got to have an understanding of how it's going to be taxed on both sides. How's it going to be taxed by Singapore or Hong Kong, or how's it going to be taxed by Canada, or how's it going to be taxed by the US, as an example? And then do you get a tax credit on the Australian side for what's going to happen when you start withdrawing from it? Is it better off to do a lump sum, an income stream? These are really important, I guess, key data points you really do need to be able to, one, make an informed decision, but also to be able to build a strategy around that as well. And I think in the past, when I've had conversations, I've spoken to a lot of Aussies that they've had a call and said, yeah, I've just withdrawn that foreign pension. I was like, oh, okay, how much was it? I was like, oh, 250, 400,000. I was like, when did you return to Australia? Oh, a few years ago. And, you end up being the person that brings the bad news, because it's like, listen, unfortunately, that's going to be treated as tax. Yeah, that's right. It's going to be taxable in Australia by the ATO, so you're going to pay a whopping big amount in tax to the ATO, and it's not something you can undo. You can't just throw it back in and undo that. So it does really emphasize the point of getting advice before you look at doing anything like that. Otherwise, you could face the repercussions of a very large tax bill from the ATO. So just
It comes back to that episode we did, was it 102, the importance of timing.
yeah, that's right.
That is little things done well just exemplify the results. And
Yeah,
even little tricks like, yes, you can put 110,000 into super. Yes, you can use the bring forward rule to put another 2 years in, essentially bringing that up to 330,000. But then being clever, putting 110,000 in pre-30 June, 330,000 in post 1 July. Suddenly now your calendar year allowance has gone up to 440,000. And it's just a matter of just planning things out in that sort of methodical sort of way. I think also too, the other thing that people need to remember as well is, she'll be right is an approach to managing your affairs unless you like a shit result, pardon the French. But, it's sort of, oh yeah, I'll sort that out when you get back. I mean, if you saw 20, 30, 40, $50,000 lying on the ground, would you pick it up? Yeah, you would. Well, that's probably what you get to save by doing things in the right order. And we always talk about, the 5 Ps, that really give clients the best result. That prior preparation really exemplifies how to get blood from a stone, doing things in a methodical sort of way. We're doing a strategy for a client here in the UAE who works for Chevron. He's got a 401k as a US employee, but living in the UAE. So we'll get him to retire in the UAE, draw down his 401k. And then once he's got that, then he'll relocate and move back to Australia. You come to Australia with the cash, put that into super, plus done, finished. And I think that's what we always talk about, is just that sort of just demarcating those little bits and pieces. When you're moving a RRSP, for example, which sort of operates very similar to a, Australian super scheme, there are, penalties that you have to take into account coming out of that. It's 10% on top of your marginal tax rate in Canada. It's a very similar sort of system to the 401k in some ways, but it's managing those things over their financial year. We had one client, I know you look after the Americas, but I remember years ago, one client was Canadian, but then went to China and done all sorts of loops around the place, like most expats do. And it was amazing, by drawing his RRSP out a week after he resigned from his company in Canada, put him into a new tax year, dropped his tax rate right down, because it's all assessable marginal tax rates. Just a week. Just doing that. Just, okay, don't do it yet. Now do it. And, it's tens of thousands of dollars in tax he saved just by doing things right. So unless you got that money to lose and you don't really care about it, then fine, do what you want. But I've never met a client who's like that.
Yeah, that's right. And it's so true. And you always wonder whether it's something where the ATO needs to either go back to the drawing board and provide some further guidance, or open up further on the tax treaties to just encompass the tax treatment of that and go, okay, taxing rights should only belong to one country and the country in which it's currently based. That would be terrific for all of us Australians, because again, we don't really pay tax on our Australian super when we withdraw it. But if we're a tax resident of another country, they're not going to provide the same relief. It might be a case where they might treat it as some sort of foreign sourced income. We've seen how it can be treated on the UK side, especially the US side. It really just depends how you're drawing that out. But, making sure you have a strategy around that as well.
I think, you're spot on. It really comes back to just, having a good hard look at what your calendar looks like over the next 1-2 years, and just having a good think and sit down and say, rightio, these are the issues. Do your research. If you don't have the capacity, reach out to us. To me, it's those little things done well that just give you the extra bump here and there. And, I was talking to a client in the UK yesterday who has relocated back to the UK. Obviously, we've discussed before, and we've done it on the blogs as well too. If you're drawing from an Australian super in pension phase while living permanent in the UK, you get taxed by HMRC. And I said to her, do you have any plans to come back to Australia? She goes, yeah, I'll probably come back in a couple of years' time to do one last tour, and then that'll be it, back in the UK permanently. I said, great, let's not turn on your pension yet. You go to the UK, enjoy Blighty for the next couple of years, come back to Australia, become a tax resident. We'll then turn your super scheme on to being an allocated pension. We'll then draw down the whole amount. And then you return to the UK with this metaphorical briefcase full of cash. Because you're an Australian tax resident, when you draw it down, you're not taxed by HMRC on that money coming in. But if you're a tax resident in the UK, drawing on, even if you did a income stream or the whole amount, HMRC would ping you that. And I think we work out there's about a $68,000 difference in tax. And
There
she
you
gets
go.
a holiday in Australia. But she pays for her trip around Oz.
Yeah,
So
that's true actually. Yeah, especially residing here for a bit longer. So,
yeah,
I mean, that's just going and drilling down on the importance of timing. We'll really tie it back to that previous episode and just having a really good understanding of how your foreign pension is treated, taxed by one, where you're residing right now, current country, plus the ATO, is there any sort of treaty or anything like that which covers it? Most of the time, most foreign pensions that we've come across, and there's definitely been a few, there is no scheme that you can just roll it over into an Australian super fund. Um, the only one that comes close, even within a sniff, is probably the UK pension, but minimum criteria 55, have to abide by contribution caps. There's applicable fund earnings that factor into that. And you need to actually do it via setting up a different pension in the UK as well, which is a SIP, but then you might have to have multiple SIPs because
yeah,
of the contributions.
sips of sips.
Anyway, yeah, exactly. So
Yeah,
it just goes on, and that's why it's not an easy process to bring
no.
home a UK pension. It's you do have to jump through quite a few hoops to appease the HMRC.
And sort of the chicken and the egg too, because you need to set up an SMSF with a very specific trust deed for HMRC
Yes.
to recognise it, but you can't do that as a non-resident because central management and control. So you have to actually wait to get back in Australia and virtually start it on day
Oh,
one. So
that's it.
yeah, you're doomed from the start.
Yeah. And and taking that a step further, like SMSF shouldn't just be set up by anyone. You need to have minimum capital and you need to have a really good sized super fund to warrant an SMSF. Hell, I can't remember the last time I even recommended one because most
Yeah.
people that I've seen have them that have come for a consult, they shouldn't have one in the first place. Their
Yep.
balances are way too small. And they want to just invest in things which you can invest in most super funds these days.
Yeah.
The only reason I've seen them, this is going back 10, 15 years ago, that people like to use them. It's really good for small business owners if they're going
Yep.
to own an office,
Buy their
and
premise.
that,
Yeah.
that's right. Like that's probably the most old school SMSF strategy that probably exists. And it's usually only specific for small business owners that are leasing it an office and they want to buy the office within the SMSF, lease it back to them, and then at the end they sell it, pay, reduce tax, and then they cash in, turn on the pension, off you go, blah, blah, blah. So, yeah, that's the other one. Just if SMSFs, you really need a really healthy balance in order to, warrant even establishing one. But I think we've probably dispelled a lot of myths in today's session, Brett.
Mate, I think it's been a good one. Just a bit of housekeeping. You guys have your mortgage and property webinar coming up at the end of this month.
Come up.
So I'll put the
Yep.
link down below. And also you've got the US stuff coming up in December too. So
Yeah, that's
you've
right.
got quite a few
Yep.
webinars going on. You'll be a busy boy.
I
Um,
am.
and I haven't done it for a while. I'm going to do a quick call to action, folks.
Yep.
Please, 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 reviews, likes, subscriptions. Once again, we're trying to have these conversations scale. As you can see in the episode today, we've given a lot out for free. All we ask for in return is just a bit of a thumbs up. Hit the subscribe button if you're watching on YouTube. If you're on the podcast, give us a rating, give us a review and subscribe. And mate, we'll look forward to seeing you on the next episode.
Sounds good. Thanks for stopping by, guys. Talk to you soon, Brett.
Cheers. Thanks, mate.